All right, have you ever stared at a stock chart and thought, what am I even looking at? This is just random noise. Well, if that sounds familiar, you're in exactly the right place. Today, we're going to decode one of the most foundational concepts in all of trading, support and resistance. Let's dive in. And look, it's a totally fair question, right? You see prices zipping up, zipping down. It can feel completely chaotic and unpredictable. But what if I told you the market isn't random at all? What if it actually has a memory? And that past price levels can give us some seriously powerful clues about where it might go next? Well, that memory, that's what we call support and resistance. And these are not just some arbitrary lines somebody drew on a chart. Think of them as the historical footprints left behind from the constant battle between buyers and sellers. And once you learn how to read them, the market starts to make a whole lot more sense. Okay, so let's start with the absolute basics. The easiest way to think about these levels is as the floors and ceilings that kind of contain the price action. We're going to break down exactly what they are and, more importantly, why they even form in the first place. So first up, support. Picture this. A price is dropping, and then thump. It hits a floor and bounces. Support is basically that floor. It's a price level where a whole bunch of buyers are just sitting and waiting, thinking, you know what, if it gets this cheap, that's a steal. I'm buying. And all that buying pressure, all that demand, is what stops the fall. And on the flip side, you've got resistance. It's the exact opposite. Imagine you're in a room and you try to jump, but you hit the ceiling. That's resistance for a stock price. It's that point where sellers are all looking at each other and going, okay, this is getting a little pricey, time to cash out and take some profits. That wave of selling is what stops the price from climbing any higher.
So when you really boil it all down, what are we talking about here? It's just simple supply and demand, played out in real time. At support, the floor, buyers are running the show. Demand swamps supply, and the price tends to bounce up. At resistance, the ceiling, sellers are in control. Supply floods the market, and the price tends to get pushed back down. It's a constant tug of war.
Okay, so we've got floors and ceilings. Simple enough, right? But here's where we level up from a beginner's view to how the pros really see the market. See, they know that the market doesn't operate with laser precision. They don't just see a single perfect line. They see zones. And it's actually really easy to do. First, you spot a swing on the chart. A point where the price clearly turned around. Now, instead of drawing one thin little line, you draw a rectangle, a box, that covers that entire reversal area. You want to make sure you get the very tips of those little candle wicks too. And boom, you've got a zone. This is so much more realistic because, let's be honest, buying and selling happens in a general area, not at one exact penny. All right, this next part is absolutely crucial. Once you start looking for these, you're going to see potential zones all over the place. But the real secret, the skill that truly separates the pros, is knowing which of these zones actually matter and which ones are just noise.
So, just for fun, take a look at this chart here. You can see a bunch of different zones where the price reacted, right? So, which one do you think is the most important? Which one should a trader be laser focused on? Is it that one in the middle? Maybe the most recent one? Or something else entirely?
Well, the answer is all about finding the dead ends. These are the absolute make or break levels. Think of them as the highest high or the lowest low before a massive game-changing reversal, with nothing but open space beyond them. They are so incredibly powerful because they represent a point of maximum emotion, either total euphoria or absolute panic. So how do you spot one of these strong levels in the wild? You look for aggression. A strong zone is born from a really sharp, fast move, like a stock suddenly rocketing up 40% in just 1 week. That shows a huge, aggressive push from buyers. Weak levels, on the other hand, they come from slow, grinding price action. So your job is to ignore the noise and focus on those big, explosive, dead-end turning points.
Okay, so you've done the work. You found a strong dead-end zone. That's awesome. But, and this is a big but, your job is only half done. Finding the zone is one thing. The real magic happens next. You have to remember, this is not a crystal ball. We are not in the business of predicting the future. We're in the business of reacting to the present. You don't just blindly place a buy order because the price touched your zone. No way. The real power is in observation. You wait for the price to get there, and then you watch how it behaves. The price action itself is what gives you the green light to act, or to just stay on the sidelines.
What's really cool about this whole concept is how universal it is. It honestly doesn't matter what kind of trader you are, whether you're trying to make a quick buck in a few minutes or you're investing for the long haul, these principles apply across every single time frame.
Think about it. If you're a scalper, you're living on that 5-minute chart, right? So you draw your zones there to catch tiny, quick moves. An intraday trader might be on the 15-minute. A swing trader who's holding for a few days or weeks, they're probably looking at the 4-hour chart. And of course, the long-term positional investors, they're using the daily and weekly charts. It's the exact same concept, you're just changing the zoom level on your map.
Okay, I can almost hear what some of you might be thinking right now. This is great, but drawing all these zones by hand, that seems kind of difficult and subjective. What if I draw them wrong? And you know what? That's a totally valid point.
It absolutely can be subjective, and that's exactly why a lot of traders bring in a little help from technology. There are tools out there like pivot points, for example. What they do is automatically plot potential support and resistance levels for you based on a mathematical formula from the previous day's price data. It's a fantastic way to add an objective layer to your analysis because you can bet thousands of other traders are looking at those exact same computer-generated levels.
All right, let's start to pull all of this together. We've gone from the super simple idea of floors and ceilings all the way to the finer points of strong versus weak zones. So how does all this actually give you an edge, a real, tangible advantage in the market? If you walk away with only 3 things from this, let it be these. Number 1, think in zones, not thin little lines. The market is a messy battlefield. Number 2, get really good at telling the difference between the strong dead-end levels and the weaker noise in between. Focus on what really matters. And number 3, probably the most important of all, watch how the price reacts. The zone tells you where to look, but the price action tells you when to act.
And at the end of the day, please remember this. Support and resistance is not a crystal ball. It will never, ever be 100% perfect because nothing in trading is. Its true power is strategic. It helps you map out the high probability areas on the chart where you can plan your trades and, just as importantly, where you can manage your risk effectively.
So by learning to read the market's memory, you're fundamentally shifting your perspective. You're no longer just getting pushed around by what looks like random noise. Instead, you're identifying the key battlegrounds where the big market decisions are actually being made. So the only question left for you is, now that you can see the battlefield, where are you going to place your bets?